My name is Himangi, and I'm from the marketing team at ShareSide. It's great to have you all here today. I'm here in North Sydney with Vince, the CEO and founder of Live Sherpa, in their swanky studio. Thanks for having me, Vince.
Well, it's great to have you at Sherpa HQ, and it's always good to talk all things stocks and ETFs with the ShareSite team, the
Exactly.
best provider of portfolio management software in Australia. So we're big fans of ShareSite. Our members get the ShareSite portfolio, and our paid members, that is, and we use it quite regularly.
And I am excited to kick off the second session in the Investing Masterclass, which is run by Win Scully. So today's hot topic is growth investing with ETFs. Before we begin, however, let's do some hygiene things, get them out of the way. For all our new attendees who didn't know about ShareSide, we're an online portfolio tracker, like Vince mentioned. We aim to empower investors by simplifying complex investment data, by helping investors make informed decisions and become savvy investors. With over 400,000 users globally, our goal is to bring institutional level insights to all investors, from beginners to experienced investors, or even intermediaries such as financial planners and accountants. And for those who are meeting Vince for the first time, Vince is a veteran financial advisor with over 35 years of experience in this industry. He was named one of the 50 most influential advisors by the Financial Standard. And he's not only the author of 2 books, he's also the founder of Live Sherpa, which is Australia's most affordable financial advice service. Live Sherpa has even received the Finnies Award for Excellence in the Wealth Management by FinTech Australia. And without further ado, let's get started. Vince, over to you.
Well, thanks, Himangi. That's a great introduction. I couldn't have written it better myself. So for those of you who were here last time, and indeed for those of you who weren't here, we covered off what I call the 5 Bs of investment, which are the 5 asset classes. And today we're going to look at how we can implement the growth categories in ETFs traded on the Australian Stock Exchange. So I'm going to start by doing just a quick recap on where we got to last time. And asset allocation is the number one driver of returns. And that's a fancy way of saying how you divvy up your investment between the 5 asset classes is far more important than whether you buy Vanguard or BlackRock or BHP or NAB. And so you should be spending most of your time getting this right. And Himangi will show you a new tool in ShareSite that will help clarify what you're actually invested in. So just recapping where we were, we introduced the 5 Bs of investing. So we've got 3 defensive asset classes, and that's bills, which is broadly cash and short-term bank bills, bonds, which are longer term, medium and longer term loans, largely to governments and corporates, bullion, which is sort of shorthand for commodities, but for most retail investors, that means gold. And then on the growth side, we have bricks and businesses. So bricks is infrastructure and real estate, and businesses is equities. So many people starting investing will start at the equity side of things, and equities are certainly the powerhouse of growth in most portfolios. And as I said, how you divvy your money up among these 5 classes is the number one driver of returns. Potentially 90% of your returns are driven by that allocation. So for, if you're used to looking at pre-mixed portfolios in your super fund or in even multi-asset ETFs, you'll have heard terms like 90-10, 70-30, and that describes the percentage of the funds that's invested in growth versus defensive. So VDHG, Vanguard High Growth diversified high growth ETF is a 90-10. It's 90% growth, which is pretty well businesses because it's equities, and 10% defensive, in that case, bonds. So when we stick to the growth assets, we're talking about bricks and businesses. So today we're going to start with the core of most people's portfolios, and that's Australian large cap equities. That is usually the largest 200 or 300 companies listed on the Australian Stock Exchange. And they're all those big names that you know day to day. You know, the banks, NAB, Westpac, CBA, and ANZ, of course. The two big miners, BHP and Rio. Two supermarkets, Coles and Woolworths, and companies that we're used to dealing with day to day. So the four biggest ETFs that invest in Australian large caps, we have A200 from BetaShares, IOZ from iShares, and STW from State Street. And those three invest in the ASX 200, the top 200. The BetaShares one is not the S&P ASX 200. It's an unlicensed variation, which is slightly more biased towards the large end of the 200. And then, of course, the largest ETF on the Australian market, Vanguard Australian Shares Index, or VAS, and it invests in the S&P 300. That's the 300 largest shares. When we look at these, so there are slight differences in fees. Fees have been trending downwards over the last few years. So the difference between the cheapest being A200 at 4 basis points, that's 0.04%, or the most expensive being Vanguard at 7 basis points. That difference is largely immaterial and won't really show up materially in your results. Here's a graph of what it looks like back to 2018. And the reason for the 2018 cutoff is A200 is the youngest of these, and it launched in 2018. So you will see that over time, there's not a lot of difference over that 5-year period. So the index itself, which obviously has no transaction costs, no brokerage, and is reinvested instantly, that returned 56% over the 56.12% in total return over that period. STW was the worst performer at 54.9%. So, 1.2% difference over 5 years. It used to be more high cost, so its costs came down later. And the best performer, which moderately outperformed the index, was the BetaShares A200. And that's largely a function of its slight overweight in the top 10. I don't believe that any of these are particularly material. The fee difference is largely immaterial. But that's not to say that these funds all behave identically. This chart is an interesting one. So this looks at the monthly returns over those 68 months where they were all available. Overall, they track each other reasonably closely, and all delivered 23 negative months in the last 68, which is, pretty typical. That's almost 1 in 4, or just over 1 in 4. And that's what you would expect from large cap Australian shares. But I think the interesting thing to take from this chart, though, is there are 12 months in which the spread between the worst performing and the best performing of the 4 exceeded 0.5%. So if you're looking at trading these things, you need to pay a bit more attention to what you're doing. And that's partly why we prefer VAS, because it is the largest and most liquid of all the four funds. It's not the oldest. STW is the oldest. And I wouldn't be paying too much attention to the A200 outperformance, that sort of statistical noise. But there were, almost every month, so 55 out of the 68 months, the spread between the worst performing and the highest performing exceeded 0.1%, which when you expect an annual return of, well, the ASX has delivered 13% average return over 122 years. So 0.1% a month is material. It does wash out over time. But when you had market allocations here, so here's the March 2020, we had that's the COVID drop. Those sort of market dislocations do create material differences in returns. Now, that's largely around the balance date, so it's really only an issue for traders. So when we look at those ETFs and look at how do we choose which of the four, so VAS tracks the 300, which gives you marginal diversification benefits. The top 200 is 97.6% of the 300. So the extra 2 and a bit percent won't change your returns all that materially. If you're looking for small cap investments in Australia, you've really got to look outside the 300 and probably look at active managers. And there aren't really ETFs that, well, there's no index to track for a start, so there aren't very many ETFs. STW and IOZ both track the ASX 200, and an A200 tracks a more obscure index called the Selective 200, which is slightly overweight the top 10 and top 20. I'm not convinced that these are particularly material, and the differences over time, I suspect, will wash out. A200 is the newest, and VAS is the largest. It's $27 billion, which is a significant but not dominating share of the total value of the market, which is $1.5 trillion or thereabouts. In terms of performance, IOZ marginally outperformed VAS, but 34 basis points over 14 years is, in my mind, statistical noise. That's not 34 basis points a year. It's a total of 34 basis points, so about less than 3 basis points a year. And a fair bit of that, I think, can be allocated to or attributed to the higher fees going back. And I think that's probably certainly true in the case of STW. A200 short-term outperformance looks impressive. It's 20 basis points a year, but I think that's statistical noise and time will tell. So of those, we prefer VAS, Vanguard, largely on the grounds of size, liquidity and history. If there's any questions spring to mind, just drop it in the chat. Moving on now to global large cap. And it's worth just looking at how markets get classified before we get into this topic. So there are two key index providers. There's MSCI, which is Morgan Stanley Capital Investors, and they obviously produce the MSCI or MSCI index, and markets get classified between developed markets, which are ones where you can be confident of the rule of law. They've got well-regulated markets, accounting standards are good, and market surveillance is good. So you can rely on those. There's about 23 of those, and they're all the big markets you would be familiar with. So most of Western Europe, North America, Canada and US in North America, Australia, New Zealand in this part of the world, Japan, Singapore, and Hong Kong in Asia, and excuse me, and then there's a bunch of emerging markets, which are markets that are not quite as developed. And there are some of those in Eastern Europe, so Poland, Czech Republic, Greece, Hungary, Turkey, and more of the South American and Asian countries. So they're getting there. Some of those are fairly large markets in the scheme of things, but less well regulated, less efficient. And so there are some opportunities there. But the advantage of them is that they tend to grow faster. And GDP growth is a big generator of equity returns. But the point of putting this slide up is there are some subtle differences between how MSCI and FTSE, or Financial Times London Stock Exchange, classify countries. So, for example, South Korea is treated as a developed market by FTSE or FTSE, and it's an emerging market for MSCI purposes. So if you're mixing funds that track MSCI indexes and FTSE indexes, you do have to be careful you don't either go overweight some companies or underweight some companies. So if you linked a MSCI developed fund with a FTSE emerging market, you're going to miss out on South Korea. And South Korea is a particularly important growth economy. And you may double up on some of the Eastern European countries. So take that with care and look at what's in these indexes. So moving on to the available funds here, you'll recognize many of these names if you've played around in the market at all. IVV is a iShares fund which tracks the S&P 500, the 500 largest companies in the USA. And the US is about 60% of the global market, so very important part of any portfolio. The other main exposure to the US market is VTS, which is a Vanguard Total Market Index. Total market meaning includes not only the large companies like the S&P 500, but also mid-cap and small-cap. Now, the Australian investment in this is it's actually a depository receipt. So what you're buying is a piece of paper that's backed by a unit in the US fund, VTI, which is listed on the New York Stock Exchange. It's also one of it, and that invests in a US-based Vanguard fund called VTS, and that's one of the 12 funds that owns Vanguard. So structurally, this is a very different beast. The CRSP Total Market Index is less liquid than the S&P 500, so that's an issue for traders who want to exchange, to try and help keep the NTA and market price together by exchanging the underlying basket of shares for units and vice versa, because the cost of hedging goes up slightly. So the plus is you get exposure to mid-cap and small-cap. The downside is hedging's more complicated, therefore spread should be wider, and you've got these structural problems. The structural problems are the deal breaker for me, and we're not a fan of VTS at Life Sherpa. Then moving out of the US, we have VEU, which is the Vanguard All World ex-US, and that tracks the FTSE All World ex-US. All world in that context means all developed world. It's a bit confusing. So it's the 23 countries that go to make up the FTSE All World, excluding the US. VGE is Vanguard's Emerging Markets ETF, and it tracks the FTSE emerging markets, including China A. And that's an important qualification, that second bit, because it does give you a significant exposure to China. And yeah, it's the 60-pound gorilla in this part of the world, but it's got a whole bunch of regulatory and rule of law problems. IOO is a global top 100. It tracks the S&P Global 100. So that's the 100 largest companies around the world in the developed world. BGBL, Beta Shares Global Shares ETF, tracks an obscure developed market ex-Australia large and mid-cap index. It's relatively new. IVE is, it's an iShares product, and it tracks the MSCI EAFE, so Europe, Asia, and Far East is what that stands for, which is really the developed world, according to MSCI, less the USA and Canada. And then finally, VGS, which is a MSCI World ex-Australia. So that includes, that's again a developed world. So lots of choice there. I've deliberately excluded, there are a bunch of currency hedged products. I've deliberately not included those on this list here because we believe that overseas equities should not be hedged. And that's because part of the reason for going global is diversification. And diversification comes from markets, it comes from currencies, it comes from regulation, it comes from industry focus. So you don't want to hedge away your currency diversification. Now, that's not the case with bonds, where what you're looking for in going global is diversification in issuer, and you don't want that currency risk. So we generally take the position that equity should be unhedged. For an Australian investor, that actually creates a interesting self-hedge almost, because the Australian dollar is a commodity-based currency. So when economies are booming, commodities generally go up in price, which drives the Australian dollar up, which obviously when the Australian dollar goes up and you're invested offshore, the value of your overseas assets falls relatively. Whereas when the opposite happens, markets decline, demand for commodities decline, Australian dollar declines, and investors look for the security of the US dollar, which then gives you a boost to your overseas shares in Australian dollar terms. So for all of those reasons, we believe equities should not be hedged. For those of you who've invested in the Vanguard Diversified Multi-Asset ETFs like VDHG, they do include a hedged portion, and they raise some interesting arguments in their white paper, but we believe that the costs of doing so and the loss of diversification and the loss of the natural hedge of currency movements is not suited to Australian investors. A US investor could very well benefit from some hedging, but we're based in Australia, so as an Australian dollar investor who will be spending their money in Australian dollars, you don't want to be hedged. So when it comes to our preferred ETFs, again, emphasizing the adopt an unhedged position, we like IVV VEU as the global pair. and adjust downwards our Australian holding of VAS to reflect the fact that VU's got about 4% Australia in it. This is low cost, and it gives you the flexibility to adjust the US position from time to time. The US has over time become a greater and greater part of the world, and sometimes you need to trim that position. And IVVVU gives you the ability to do that. We deliberately eliminated VTS for a number of reasons, primarily around the Vanguard ownership issue. And this is important that, and for some reason, it's not disclosed in the Australian prospectus. The Australian prospectus does reference the US prospectus where this is disclosed. And VTS, which anyone who's read J.L. Collins will be familiar with, VTSAX, which is the Admiral shares in the unlisted fund, is one of the 12 funds that owns Vanguard, that company, which means that some of the money you invest in VTI or VTS is invested in Vanguard. It's also party to an agreement called the Fifth Restated and Amended Funds Distribution Agreement, which you can Google and download off from the SEC, but the ASX decided you didn't need to know about it. And that provides a requirement for these 12 funds to invest in the company and to indemnify the company for certain expenses with a cap. And whilst this is a small risk, the major risk being IT project overruns, litigation that's not covered by insurance, and marketing that just doesn't work. It's a risk that you should only take if you're being rewarded for it. And 5, 10, 20 years ago, Vanguard was by far the cheapest game in town. And in those cases, it made sense. But now that it's within a basis point or two of the competitors, we don't think that's a risk that retail investors should take. And then you add in on top of that the complexity of the CDI structure and the extra cost to hedge the CRISP index, which should see spreads wider than other funds. And VGS, VGE is the other combination that people would often use. And we think that the mismatch between the MSCI and FTSE definitions of emerging and developed markets make that a unsatisfactory replication of global markets. So our preference here is IVV, VEU, and that's a relatively low-cost way of doing it. So I'm sure this should be triggering lots of questions in the chat, which we will come back to. So keep throwing your questions in. The next B is BRICS, and we'll start with infrastructure. And infrastructure is an interesting one. So for those of you not who haven't been following this, infrastructure is all of those things that a modern society needs to live and thrive. You can sort of break it down into telecommunications, transport, and energy. So telecommunications, telephone, data, transmission lines and towers, and satellites. Transportation, all the usual, roads, railways, bridges, tunnels, ports, airports, canals even. And on the energy side, electricity generation, distribution and transmission, pipelines and water supply. Now, all of those industries are highly regulated. In many places, the government sets the price, and the demand for many of these products is relatively stable. And for that reason, some people treat these like bonds, that they do have some defensive characteristics, But I think the better way to characterize them is as low beta equities. So they're equities because these are businesses, and they tend to move around less than the market as a whole. So where the market moves 1%, you might expect a member of the infrastructure index to move by 0.6 or 0.7. And that reduced volatility helps to dampen volatility in your overall portfolio without giving up return like you'd have to with bonds to get the same effect. They also tend to have inflation-linked revenue streams, so they tend to perform very well in inflation environments. The last 2 years being a key exception to that, and they also tend to benefit from low interest rates, which does two things. One, it reduces their cost of debt, and they're generally highly leveraged, and two, the valuations tend to be based on risk-free premiums. So a rise in interest rates will generally see the value of an infrastructure product fall. So we see these as, if you go back to your 5 factors of investing, if you've read the Farmer French factor model, you'll see that the market premium was the first of the 5 factors that was discovered. So mixing in some low beta stocks can deliver good dampening of volatility without giving up returns. So infrastructure is an important part of any portfolio. And when we look at how do we buy this, there are 4 major funds on the market here. We've got the iShares Core FTSE Infrastructure here, GLIN. It tracks the FTSE Developed Core Infrastructure 50/50. And it's hedged. So the 50/50 refers to capping within sectors. So rather than looking at the whole of the core infrastructure sector, the 50/50 index caps the telecommunications, transport and energy. So you get, you're not reflecting the market as a whole. We don't like this capping, so we would prefer a straight core infrastructure. We do like core infrastructure, so that would include a lot of developers, so people who develop wind farms, for example, rather than own and manage them. It would include, the non-core stuff would also include engineering contractors, designers, and they're much closer to traditional businesses and a much higher beta. So we look at the core infrastructure when we're looking for an index here. VanEck IFRA tracks the FTSE, again, developed core infrastructure 50/50, and both of those are hedged. It is often hard to find an unhedged infrastructure product, and that's because, and I'm going to put my hands up as being guilty for spreading this rumor. I was involved with the Macquarie infrastructure team in the very early days. And when we were trying to sell infrastructure to fund managers, we were trying to convince them that this was bond-like and could be a substitute for bonds in the portfolio and could be a substitute for real estate. And as a result, many people developed say, well, if it's a bond, I should hedge it. And so many infrastructure funds are hedged, and we would rather see these things as low beta equities rather than bonds. So we would recommend they be not unhedged. The unhedged option here is VBLD, the Vanguard Global Infrastructure Index. And not only is it not hedged, it tracks the developed core infrastructure without the 50/50 overlay. So that's definitely our preferred option here. Despite the fact that it's got a slightly higher ICR, so it's more than twice the price of IFRA, and it's 3 times the price of the iShares product. It's unhedged and it's core, so it's our preferred. Magellan have an actively managed fund, which is they do have an active hedge. It's mostly hedged, but they do have the ability to actively manage the hedge, much like the Platinum Global Fund. That's a fairly concentrated portfolio, and they've made some very poor calls in US electricity utilities. So we don't like this product, despite the fact that the manager's got a really good pedigree. And I know them from my infrastructure background, but they've made some very poor calls, and it's a bit too concentrated for our likes. So VBLD is our pick here. And so that's because we want to adopt an unhedged position. We want to be focused on core infrastructure. We don't like artificial sector capping. We want to focus on developed markets, and that means VBLD is our pick here, despite its higher ICR. Which then brings us on to the second bricks, which is real estate. And real estate in this context, we look at core rental real estate in this context. We try to avoid the developers and the what our American friends call REOCs. So the US divides real estate funds into REITs, which are close to listed property funds in an Australian context. They're generally buy and hold funds. They're generally buying assets for rental income and long-term capital growth. And that's in contrast to a REOC, which is generally more involved in development, refurbishment, flipping. You do get a little bit of exposure to REOCs and diversified funds within the core real estate index, but relatively small. So the big players here are the Vanek Vectors REIT, REIT. They got the best ticker, but not necessarily the best funds. The NAREIT developed rental index would probably be our preferred index, but unfortunately this is a hedged option. It's very cheap, but for the hedging, this could be our pick. DJRE, the State Street Spider, tracks the Dow Jones Global Select Real Estate Index. The ESG overlay on this is relatively new. So it's a core rental index primarily. They applied an ESG overlay in 2021. The jury's out a bit on that. I'm not sure it's got a material impact on either the underlying assets or the expected returns. It does have a relatively high ICR, but it's probably our pick here. iShares, again, tracking a NAREIT index. Unfortunately, it's hedged again. And we've got an actively managed one here, RCAP. Again, you'd expect these guys, these are probably one of the best active real estate managers in the world. This particular fund hasn't really performed all that well. It's got a relatively high ICR, and it is mostly hedged. So again, we take the one unhedged option there. We like DJRE. It's unhedged. It's focused on the core with limited exposure to specialists and developers, and it doesn't have any odd capping rules. So DJRE is our pick there. So that's a quick run through of how we select the ETFs that we include in our portfolios. And, you know, the best ETFs individually don't necessarily make the best portfolios. It's like a good footy team, that a team of champions doesn't always make a champion team. And it's how you put these together that really matters when it comes to building a portfolio. and the relative mix is what generates returns at lower volatility. So before we move on to questions, I think it would be time for Hemangi to show us the new feature in ShareSite, which helps you look through your holdings to the underlying assets and asset allocation. So over to you, Hemangi.
Excellent. Well, I mean, ETFs are now becoming a popular investment type. So, I mean, thanks to
We love ETFs.
yeah,
ETFs are us.
they're so popular now, and just so that you can manage your ETFs and understand your ETFs a bit more, we have a handy tool that might help you make informed decisions about your investing. It is called as the ETF Exposure Report. So, other than just tracking your portfolio online, ShareSite also offers you a very comprehensive reporting tool, which not only includes reports during tax time, but it also helps you look into your portfolio through a diversity report, a consolidated report, and to get started, an ETF exposure report. Before I give you a demo of that, I would like to just state that we don't have an AFSL, so please don't consider this as financial advice.
I do financial advice.
Yes, not asset share side. So this in front of you is a sample portfolio, not a real one. You can see that I have three of the holdings in ETFs, and I have a bunch of individual holdings as well. Now let's check out the exposure report. So for existing ShareSite users, all you have to do is just hop onto the report section. This is currently only available for the Investor and Expert and ShareSite Professional plan. There you go. These are all of our reports that give you a good insight into your portfolio. Let's run the exposure report, see what it's like. We also have a little tutorial there where you can have a detailed look later. There you go. So by default, this goes on a do not group setting. Now, this report will show you your top 50 holdings by weight in each of your ETFs, and the remaining ones will be down below in your residual ETFs. Bear with me a moment. They are residual ones. Now, when I'm in the do not group default category, it really just gives me a very clear view of my direct stocks that I hold against any ETFs that I might have. So as you can see, I've got a direct holding in Apple, but I also have underlying holdings in Apple through 2 ETFs. So at this point in time, depending on any individual investor's investment journey, they're free to use this tool to help them decide if they want to buy, hold, or sell a particular holding. As you can see, this is a do not group. Now, if I want to get a bit more insight, I can also group this by sector, market, currency. Now let's go by sector. Let's try that. And there you go. Let's run that report. There you go. I have a very clear idea that my portfolio is skewed towards technology. Some residual ones, and then some in retail, none in infrastructure like we went through before. But I also find it very useful to see it by country. I like this particular portfolio, which is not my personal portfolio, it's just a sample one. It has a good mix of holdings in every country. So as you can see, United States, Australia, UK, India, and then all the rest of my
So if you
residual
compare that to the MSCI World, for example,
Yep.
you'd be slightly underweight US.
Yep,
You'd be well overweight Australia, which is probably appropriate for an Australian investor.
exactly.
You're way overweight India and well underweight United Kingdom. So it's a really good snapshot of how do I compare with the MSCI, and are these differences deliberate, or is it a consequence of unintended consequences of other decisions. So I like these sort of reports that really nail where I am relative to the indexes I'm tracking. Now, there are good reasons why you might want to diverse from the index, but it's important that they're done intentionally.
So, provided it just gives you a good snapshot, literally, of what your current portfolio is, and it gives you a lot of confidence to then make informed decisions about what you should be doing in your personal investment journey, obviously. And ETFs are now becoming very popular. A lot of times, people also wonder that when I add these ETFs into my portfolio, what does it do for tax? What during tax time? Does that cause any implications? Well, just to help you out with that as well, we also have a different tax time reporting tool within the reports tab. For example, just simple tax and compliance tool to help you run those reports. So along with the exposure, with the tax time compliance, you get a good snapshot of your holdings, your ETFs, your direct holdings versus your ETFs. And that really does, hopefully it helps you, make, again, informed decisions as an investor.
The other report that we use a lot with our members at Life Sherpa is the unrealized capital gains report,
Right.
which again is a paid feature.
Yes, it is. It is.
So that's one that, if you're trying to make a decision, do I replace my, I'm going to move from VGS, VGE to IVV, VEU. What's going to be the tax consequence of doing that? If you've got less than 10 funds, the free one will tell you what's happened after you've made the transaction.
Right.
But the unrealized capital gains report will allow you to make that decision a lot more intently. So one of the ones we use a lot, and looking forward to having the exposures. Is that exposure one live now?
Yes, it is live now.
Okay.
It is now live. And everyone, again, who's on an investor, expert, or a share side professional plan can hop onto it and look at their entire portfolio, compare their holdings with their ETFs. It is now live, so it would be nice. It's a nice little feature to add on to the growing popularity of ETFs.
Cool.
Well, to be honest, you've got a lot of nice questions coming in. Do you want to
So you're going to read the questions out now?
Yeah.
So I'm sure that was going to raise a lot of questions. We covered a lot of ground. The question, these are being recorded. You will get a copy, a link to the recording tomorrow. The recording for the last webinar is on the ShareSide.
Yep, it's on our YouTube. It's on the ShareSide YouTube channel.
Paolo, have you put the link in the chat somewhere? And so let's get into the questions.
Let's go. Particularly, this one caught my eye.
Which one? Do you want to read it out?
Would it not make sense to buy a hedged IVV if the AUD is weak versus USD, under the assumption that if the AUD gets stronger in the future, one's investment would be relatively weaker?
That's a true statement, that obviously if you buy IVV and the A dollar gets stronger, the value of your investment goes down. And if you are trying to make a currency play, buying equities is not a particularly direct way of doing that. So if you're trying to take a view on the currency, you should either buy or sell the currency or buy or sell bonds. Buying a portfolio of equities to take a currency position is quite inefficient. If your argument is that I want to buy equities, but I think the Australian dollar is going to rise, that's a variation on market timing, which is particularly difficult to do with currencies. The long-term Aussie dollar US is remarkably stable. It moves up and down. And so our view is if you want to take a currency position, take a currency position. If you want to take an equity position, take an equity position. And if you want to trade currencies, I'd be trading bonds. And we look at this when we look at the defensive Bs in the next episode of the next installment of the series. A, we don't do market timing. It's remarkably difficult to do right. And B, there are much better ways of taking currency positions than buying equities. So no, whilst the statement you make is true, you translating that into a portfolio construction decision is not as straightforward as you might suggest. So I would be buying I'd be taking my currency position in the bond market.
Awesome. Let's look at this one. What is your take on owning IVV and BGS?
The reason you might want to buy both of those is if you wanted to take a global position with an overweight US position. So, which is partly why we take the IVV VEU structure, because VEU doesn't have a US position, so it's much easier to see through to your exposure. With an IVV VGS combination, in order to work out your US position, you need to work out how much of my VGS is in the US and how much of my IVV, and obviously 100% of your IVV is in the US and Canada. So yes, you can do it. We just don't think it's as clean as neat. But if you're good at spreadsheets or you've got the share side exposure report, yep,
Well,
you could go either way. But our view is that IVV VU is cleaner and neater. But yep, you could go that way.
would you consider PPOR a sufficient real estate holding in a portfolio?
That's a great question. A lot of people ask this question as, does my home count as a real estate investment? And the short answer to that question is no. And the reason I say that is that ownership of your PPOR is more a hedge against future rent than an investment in its own right. It's potentially a store of value, but it's really consumption that happens to have a residual value at the end of it. So you can consume 30 years of accommodation services from this piece of real estate and it still has some residual value. But you shouldn't be treating it as a real estate investment. The next step is, well, what about an investment property, a residential investment property? Is that real estate? And yes, it is, but it will behave very differently to a commercial, industrial, retail property investment. So they're good complements. So, a REIT investment is not a substitute for residential property investment. And so both have a very important part to play in a balanced portfolio. Most people should have a little bit of both. So I always get very frustrated with the property or shares argument. The argument is really how much of each and when, rather than one or the other. They're both important parts of a balanced portfolio. But your home is not an investment. So it's an important part of your net worth. It's an important hedge against future growth, against future rental prices, but it's not an investment. It may give you a return, but it's not an investment. It's consumption.
Yeah. We have time for one last question. Let's go with what percentage of each of those ETFs should you hold?
Now, that's I guess the $64,000 question, and that's the ultimate. It depends. So as your risk profile changes, your percentage allocations will change, and the percentage allocations will change over time. So probably in the fourth episode of this, when we come on and look at portfolio construction, we'll address those questions in more detail. But the answer is that portfolio construction is about constructing a collection of assets which complement each other, represent each of the 5Bs, and deliver the return that you need or seek at a volatility that you're prepared to tolerate. And you really have to look at those two parameters in one. And we'll see, I can give you a worked example of how you can generate a return very similar to a 100% equities portfolio from an 80-20 portfolio with the right mix of these assets. And volatility is a critical part of achieving the returns. I've lost track of the arguments I've had on Reddit with software bros who say, well, you can't eat risk-adjusted returns, and that's true, but you can only eat the returns that you actually achieve. So tune in for episode 4, I think, when we're going to look at putting these all together. And the short answer to the question is, it depends. So what else have we got here?
Got this one.
Yeah, a question around, we probably have time for just one more. Question around US estate taxes and US domiciled funds. This is a tricky one, and certainly if you are holding large quantities of US assets, you do need to be careful. The tax treaty, it does help. This is a very complicated exercise. So my general view is if you're not American, you should, in general, avoid the US assets unless there's a very good reason to hold them. If you're investing 50,000, this is a non-issue. If you're investing $1 million or more, this is a very live issue. So for most Australians without a US connection, the less of your assets that pass through the US, the better. It introduces a number of tax inefficiencies that could be solved by Australian or other domiciles like Luxembourg, Ireland, the Caymans. But sometimes there are no choices. But it's really only a problem if you have a large investments. So another good reason to take professional advice and not rely on Google.
100%. I think we're
running out of time. Well, good job. There's 3 more episodes to come.
I know. This is not the only episode left in the Investing Masterclass. We plan to come back with Vince back, and stay tuned. You will be receiving an email shortly with the session link in case you missed it, along with the previous session, which is available on ShareSide's YouTube channel. Today's session will also be up on ShareSide YouTube channel very, very soon. And thank you for joining us today. It was lovely to have you, and we are so looking forward to meet you at the next edition, the 3rd edition of the Investing Masterclass with Vince Scully.
And just to be clear, everything here was general advice only. I don't know any of your personal details, although I do recognize some names in the chat. But it is general advice. We do have a financial services license, so we can provide financial advice, but all of this advice is of course general advice and hasn't taken into account your personal circumstances, goals or objectives. We're more than happy to give you personal advice. Membership is available at the site lifesherpa.com.au, which includes a ShareSite Pro account.
Yes, ShareSide. investor.
Investor account. So thank you for joining us, and we look forward to seeing you next time. Same bat time, same bat channel.
Yes. See you next time.
Thank you.
Good night.